Good morning, everyone. Welcome to this update for global stocks and commodities for the 1st of July. Last weekend, I would have commented that markets were sailing along quite nicely. The S&P looked like it was just consolidating under 2,800. And look, to be honest, not a lot has changed with the S&P, but there certainly was some pretty hefty selling in some sections of the market, particularly in the Nasdaq, which had been leading the market, and also the Russell. So there was a significant sell-off on Monday that was really triggered by the ongoing trade situation between the US and China, and not helped, China stocks not helped, of course, by the fact that the yuan has gone through a significant devaluation by market forces, not by government regulation. But market forces pushed that down with concerns about the Chinese economy, and it was generally a very disrupted week. So heavy selling on Monday, heavy selling on Wednesday, and a bit of a half-hearted, bit of a half-hearted rally on Thursday, and then again the market closed weakly on Friday, closed on its lows. So I'm definitely seeing, particularly when you look across a few hundred individual stock charts, I'm definitely seeing that there's been a change in sentiment in the last week. Now, 1 week doesn't set the trend. We need to see how that will play out in coming weeks. But certainly, it's a little bit of a cautionary flag, at least anyway. So let's jump in and have a look for this update. I just want to examine this change of character a little bit further, and I think you've really got to err on the side of caution and expect that we could see lower prices in the short term. Now, none of this changes my longer term thesis in terms of where the market is going. That's new all-time highs in the S&P by before the end of the year, and probably well before the end of the year. So none of that changes. And technology leading the market, that doesn't change either. But markets just go through shorter term cycles, and I think we might be just going through a little bit of a shorter term down cycle. And of course, I'll be looking at the normal stock and commodity trend updates. Some interesting moves there. And last week in Portfolio Analyst, I did, amongst many other things, just introduce a methodology to generate some significant monthly incomes that could be very, very attractive for some people. Not for everyone, but for some people. Now, the S&P index ended up down by 1.3% for the week, so that's not inconsequential. It's still within the consolidation zone, but as I said earlier, there's been an unmistakable shift in character. It just remains to be seen whether that's a longer-term shift or whether it's just a very short-term reaction. Finally, the market reacting to what's going on between America and China. Now, all the indices were on their session lows on Friday. We had a good start, which was nice follow-through from Thursday's reversal, but it all failed rather dismally on in the last hour or two on Friday. So it's not a particularly good indicator for the start of next week. And this may be more than just a reaction from overbought. Now, I said that 2 or 3 weeks ago that the US market was overbought. It was at 2,800 on the S&P, which was key resistance, and that we would probably get a pause and a bit of a pullback, and that's what we're getting. The US dollar was strongly higher for most of the week. It ended up holding on to some very small gains on the week, but lost most of it on Friday. So that helped to boost commodities. Not that oil needed a boost because it's running under its own steam anyway. So let's take a look at the US markets. So we'll start initially with a monthly chart just to get a nice big picture view. So this is a monthly chart of the S&P. These peaks here were 2000, 2008, and then we've had this extraordinary run up since March of 2009, and you can see that we're still very buoyant. The blue line is the 10-month moving average. The red line is the 20-month, just to give us a sense of how the trend is going. You can see that the gap between those two moving averages, and being a monthly chart, this is very big picture stuff, so you'd never want to trade against this. But it just gives us a sense of perspective on where the market is. So the 10-period moving average is still moving well above the 20-period moving average. The price is still above both of them. We still unquestionably have a bull market at a big picture level. There's just no other way to interpret that. Let's look at the daily now. So as I've been showing now pretty much all year, we had a continuation of an uptrend that was the trend of 2017. So this line through here shows us the trend through 2017, and the price of the index was just a little bit above and below that trend. So that was a pretty good representation with only relatively small fluctuations on either side. We then got a massive blow off in January, and that has now deteriorated. Initially, it looked like it was still continuing to hold that trend line, but it's now deviated to the downside of that trend line. We're still in consolidation, so as long as we stay within this box, so if I could just highlight here, so as long as we stay within here, it's still a consolidation. Really don't want to see a breakdown below 25.50. That would be nasty, and that would concern me a great deal. But as long as we remain within that green box, the bull market is still intact. And when you get a severe blow-off top like we had here, then to get 6 months or even longer of consolidation is pretty normal. So there's really nothing abnormal about what we're seeing here at all. But it's clear now that this consolidation is going to be a bit more protracted than we originally thought. Okay, that's the S&P. Let's take a look at, so just some key support levels to watch. So this level here is important at 26, call it 26.75. And then, of course, the next important level after that comes in around 2600. So they are key support levels for the S&P. Let's look at the Nasdaq and the Russell, because they've been leading the market so very well. The continuation of the uptrend from 2017 is really still there. We're still just fluctuating above and below, but you know, this could be the start of another reaction like we saw here in February, and then again in March through to the start of April. So it's possible that we could get another run down towards the bottom of this inclined trend channel. And certainly there's a lot of volume you can see came in here on Monday. Huge volume on the Nasdaq on the down, so a gap and huge elevation in volume, just as we saw happened here in February. So I think it's not unreasonable to expect that we could see some more downside in the Nasdaq and technology, biotechnology, etc. Now let's look at the Russell. So the Russell had also been incredibly strong, the strongest index of the lot in the medium term, and you can see we had a sharp move down again, a significant increase in the supply of stock came into the market, and it's come off from 170 down to 164. You might think that's a great deal, but with an index as broad as the Russell, it has some significance. But I must add that the market breadth, so that's the number of stocks that are advancing or above their 50-day or 200-day moving average, however you want to define market breadth, is still pretty robust. It's still right up there near all-time highs. So we've got to give this a little bit more time to play out. But you know, every reason to suspect that this consolidation might continue a little bit longer yet. And just to wrap up, let's look at the US dollar. So we ended up higher on the week, and we had a little breakout above this resistance level, but quite a decent amount of selling on Friday, as you can see, gave back most of the gains. And that was really more about strength in the euro and strength in the yen as well. All right, turning to Aussie stocks now. Our dollar was on again, just seem to say this every week, was on a real roller coaster. It got down to about 73.3 at one stage. It finished down 0.5 cent, but that was only saved by a late rally on Friday. And again, that's just the mirror image of what happened in the US dollar. So no surprise there. Our index fell by 30 points, 0.5% for the week. But it really is the way that our index moves, being a reflection of the top 10 or 15 stocks, has really decoupled from what's happening in America. So I really don't think you can assign any value to what the ASX 200 is doing, because it's just reflecting the banks, the miners, and a few other large stocks, Telstra, Wesfarmers, etc. Wesfarmers has had a very good rally. Telstra's been smashed. The banks have been going up and down, and the miners are probably slightly more positive than negative. So you throw that all in the mixing bowl, give it a stir, and you get a not a great deal of movement in the index itself. However, I must say, though, that our market is surprisingly resilient when you get down to the individual high-quality small cap and mid-cap stocks. There's been some very, very strong performances, and members would know that from the reflection of our model portfolios in Australia. They've done extremely well, and especially in the area of the financial technology stocks as well. So just for the record, I'll take a quick look at the ASX 200. So net, we've had a bit of a breakout over the last month or so. But as I said, I just don't think it really means very much, because it's just such a narrow reflection of what's going on in the market. Now, while I'm here, let's look at gold and silver. This is gold on a weekly chart, and it's dropped out of this upward sloping trend channel that we had basically for the last 2.5 years from the start of 2016. So that's not a particularly good sign. That's partly due to the fact that the US dollar has been rising. So that's pushed the price of gold down. But also because in a rising interest rate environment, gold just loses its appeal. And the only way that gold is going to come back into favour is with a good old-fashioned calamity and a bit of a panic. And that was something that surprised me on Monday, because there was definitely some panic selling because of perceived fears over where this trade war with China and Europe would end up. And even under those circumstances, gold was unable to rally. If we look at it on a daily chart, you can see we had a little bit of a turnaround on Friday, but that was just currency related. So gold looking extremely weak, but that then flies in the face of what's actually happening with stocks, because if we look at GDX actually finished up on the week, despite the fact that gold was comfortably down, and the Australian gold producers are looking fantastic. Now, that's heavily about the fact that the Australian dollar gold price has been going up, but I'm seeing a real divergence here, which is a bit of a head scratcher, and whenever you see that, it's quite often if you've been watching these videos for very long, you'll know that the commodity stocks tend to lead the commodity prices, and especially with gold. So this outperformance, if you like, I know GDX didn't do very much, but at least it didn't go down. And that outperformance against the price of gold is something worth watching if that starts to show any momentum to the upside. So just quickly, gold down $17 to $12.54, and the Aussie gold producers are the ones, if you want exposure to gold, and get a return, then that's really where you want to go. Other commodities, copper declined down to $3, but did bounce back on Friday, so it could have been a lot worse, as we'll see from the chart. Crude oil continued to bounce very, very powerfully, as I've been covering now for several months, up to 74.15. But interestingly, none of the sector ETFs went with it. So this is sort of the flip side. We've got oil moving up, but as we'll see from the XLE chart, the stocks weren't really on that bandwagon. Now, there's the spot copper chart. That's on a 6-month view. And then we look at crude oil. Very, very powerful rebound if you look at the short term, back up from 65 in really just the last 2 weeks. So 65 to 74, that's a huge move in crude oil. And if we pan back and take a bigger look over the 12 months, you can see just how powerful that rally has been from just under $50. We've effectively gone up 50% in a year. So that's quite massive. In terms of current positioning, this is a pretty testing time at the moment. Markets are volatile. They've got a bit of a downside bias to them in the very short term. And, when you see markets that are poised to break out, and then they just suddenly, this massive waves of selling just hit the market, it makes it tough. So this is a time to be very selective. It's certainly a time to to have a good list of quality stocks and to be very patient and wait for the market to come to you. And I think above all else, I'm just finding that in the short to medium term, which is a lot of people's trading timeframes, that the fundamentals can't be relied on. Good cheap stocks are going down. Expensive stocks are still rising. So the fundamentals I find can be quite misleading at times like this. I think you need to be guided by the price action, wait and buy a bigger dip, and just play it that way. Now, portfolio analyst this week, I'm going to be covering just some very useful rules for how to go about repositioning your portfolios when we get markets that are starting to behave as they are at the moment. So that's it for this week. There's my contact details for any non-members, and just a reminder, the 2-week free trial with Portfolio Analyst is still available, and the feedback I get is that members are really appreciative of particularly the educational component around Portfolio Analyst. So that's it for this week. Cheers.